Hello, sir. Good evening. The కొంచెం డిస్టర్బ్ అయినట్టుంది. I'm returning back to the meeting. Some disturbance there. Hello, everyone. Today's session, International Financial Management, Unit 2, on theories of foreign exchange rates. In this unit, you will be learning about the various theories in foreign exchange rates. This theory also focuses on understanding the PPP, that is purchasing power parity. We'll also discuss about interest rate parity and the theory of Fisher's effect, along with international Fisher's effect. These two theories also we will be learning in today's session. And as you can see on the screen, the present structure of the unit consists of introduction, theories of purchasing power parity, theory of interest rate parity, Fisher effect, theory of international Fisher effect, and finally, there is a comparison of 3Ps, IRP, and IFE theories, concluding with the summary and the model question paper. Now, as we all understood in the last class about international financial management, we move on to learn about the various theories involved in understanding us better these foreign exchange rates. And a country's demand for foreign currency comes from the payments for its import and capital outflows. This is a basic fundamental element which one has to understand to better understand the foreign exchange rates. A country's supply of foreign currencies comes from its exports, whereas a country's demand for foreign currency comes from the payments. So under this Bretton Woods scheme, government were required to intervene in the foreign exchange market to maintain stability of foreign exchange exchange rate for their currency to the US dollar within a specified band. Foreign exchange rate always fluctuates, and according to market forces of demand and supply, they happen to fluctuates, either increase or decrease in the rates we observe. How do these foreign exchange rates are determined? The traditional exchange rate models on relative inflation, on the relative level of real interest rates, etc. These rates are based on, like, demand for foreign exchange is determined by value of imports, while the supply of foreign exchange is determined by the value of exports. Now, both these concepts are flowing, inflows and outflows, imports and exports. Based on this, the traditional theory is based, which determines the exchange rate. Now, firstly, the tradition theory views the exchange rate as a relative price of national outputs, whereas it also assumes the exchange rate is determined by conditions for equilibrium in the market for flow of funds. Next, balance of payment model. Now, this model holds that the rate is based on goods and services. Hence, it is referred as trade or elasticity approach, which is given by Mankiw N. Grigori 2007, in the year 2007. The exchange rate equilibrium in a country produces a stable current balance. A country with trade deficits will experience reduction in foreign exchange reserve, which ultimately lowers the value of its currency. This happens when the equilibrium level of a country is, the trade deficit when a country is experiencing. And in the intermediate period, imports will be forced down and exports will rise. This enables in stabilizing the trade balance and brings the exchange rate of the country towards equilibrium, where there is a proper balance of imports and exports. These flows go into capital account of BOP, and thus they happen to balance the deficit in the current account. So this model revolves around the nation's deficits, depreciations, undervaluations, exports, etc. And this elasticity approach, more focused on flow of goods and services in the determination of exchange rate, and it completely ignores the increasing role of global capital flows. Then we have monetary model. This monetary model basically is about the price level of a country, which is again determined by supply and demand for money. And this price level in different countries should be the same when expressed in the same currency. The demand for money depends all on the real income of the nation. The greater is the demand for money for day-to-day transaction, higher is the interest rate. Even in yesterday's the previous class, we have learned about the demand and supply. Higher will be the interest rates and vice versa. This will lead to a greater opportunity of cost holding cash instead of interest earning assets. Now, this demand for money is inversely related to the rate of interest, as we have seen. It is inversely related to the demand. And proportionately, it will increase in prices and depreciation of the nation's currency in the long run. Now, another approach, that's portfolio approach, which is given by Frankel and Musa in the year 1985, which had an opinion that exchange rate is determined in the process of balancing the stock. Or in, on a brief note, it is all about, again, demand and supply of financial assets here in each country. So, portfolio approach is a rate through which we determine our exchange rate, which is again, based on the demand and supply of financial assets. Now, and this currency is traded by investor and speculators in forex markets at spot, forward, futures, and option markets. All these concepts we have discussed in previous class. The spot market represents current exchange rate, whereas forwards and options are derived of exchange rates. Now, the economic growth, inflation, productivity were the drivers which enable us to understand, considered to be the economic variables, which are no more the drivers of currency movements. The proportion of foreign exchange transaction from financial assets has dwarfed the extent of currency transaction generated from trading, that is movement of goods and services. So this model is purely based upon the movement of trade of goods and services, especially financial assets, which we call it as asset approach or portfolio approach. Now let's move on to the next model, which is given by Frankel in the year 1995, and this portfolio balance model. So this model has an opinion and focuses on the financial asset demand and supply conditions. This exchange markets participants balance their portfolios between domestic money, bonds, and currency bonds. They also focuses on portfolio modifications, which again is based on the changes in international and domestic conditions. Again, portfolio balance model is wherein the determination of exchange rate depends purely on the process of total demand and supply of financial assets in each country, in the respective country. Moving on to the popular theories of exchange rate determination, we have purchasing power parity, which is linked to spot exchange rates. Spot exchange rates, spot markets, we understood in tried to understood in the last session. Spot is all about the current, today, whatever day today, spot, whatever value, we consider it and we call it to be a spot market. Here, PPP, that's purchasing power parity, is links with the spot exchange rates to nation's price level. And the next one, that's IRP, interest rate parity. This is linked again to the spot exchange rates, for forward rates, and also nominal interest rates. And followed by, we have international Fisher's effect, which is linked with exchange rates to nations' nominal interest rate levels. Now let's see in detail about the PPP, that is purchasing power parity, which was proposed by a Swedish economist, which is Gustav Cassel, in the year 1918. Purchasing power parity basically enables or states that price levels should be equal worldwide when they are expressed in common currency. It has an assumption that free trade will equalize the price of any good in all countries. Otherwise, arbitrage opportunities would exist. And this theory believes that the exchange rates between currencies are in equilibrium when their purchasing power is same in two countries. It means that the exchange rate between two countries should equal the ratio of the two countries. Now, when countries' domestic price level is increasing, then countries' exchange rate should be depreciated. This is in order to return to purchasing power parity. And the basic law behind this PPP is a law of one price. That means two countries should have the same price. In the absence of transportation and other transaction costs, competitive markets will equalize the price of any good in two countries. When the prices are expressed in the same currency, suppose here the example is given, about a TV set for $750 Canadian dollars, and in Vancouver should cost around $500 US in Seattle when the exchange rate between Canada and US is 1.50 Canadian dollars and US dollars. If the price of TV is in Vancouver was only 700, consumers in Seattle would prefer buying the TV set in Vancouver. And this US consumer buying Canadian goods will bid up the value of Canadian dollar because there it is purchased in the Canadian dollar, and the Canadian goods goods will become more costly to them. If this process continues, goods have again the same price. Like as mentioned earlier, transportation cost, the transaction cost, all these are very important to maintain the prices, same prices in two countries. Again, there must be a competitive markets for goods or services in both the countries. Competitive market should be available, and then only this can happen. And the law of one price only applies to tradable goods. Immobile goods such as houses or any services which are available at local, of course, cannot be traded. Only movable goods can be traded, and they can be converted. The price can be converted, and we can value the purchasing power. So the economists use basically two versions, that is purchasing power parity, under which absolute and relative. Now, what is absolute and what is relative? Absolute is refer to equalization of price levels across countries. Absolute refers to equalization, equal price levels across countries like Canada, USA, Sweden, etc. Whereas formally, if the exchange rate between Canada and US is equal, the price level in Canada is divided by the price level in the US. Assuming the price level ratio implies PPP exchange rate of 1.3 Canadian dollars per $1 US. If today's exchange rate is 1.5 per $1 US, then PPP theory shows that the Canadian dollar will appreciate. That means it goes greater against the US dollars. And the US dollar in turn will depreciate because it becomes weaker against the Canadian dollar. On the other hand, a relative PPP means the rate of exchange, that is inflation rate of price levels. Now, this proposition strongly supports that the rate of appreciation of currency is equal to the difference in inflation rates between foreign and home country, like Canadian and say US. For example, here a small example is discussed, like Canada, if it has an inflation rate of 1% and the US has an inflation rate of 3%, then US dollar will depreciate because inflation rate is higher, and again is the Canadian dollar by 2% per year. And this proposition holds well empirically, especially when the inflation differences are large. Now, PPP, exchange rate in the short run. Exchange rate movement in the short run, short terms are new drivens. And these announcements about interest rates changes the perception growth path of economies, and the likes are all factors which drives, exchange rates in the short run. Of course, this can take many years. However, a time zone of around 4 to 10 years would be typical. I mean, it is estimated. And then we have how to calculate the purchasing power. Parity. The simplest way to calculate these three P's between two countries is to compare the standard good that is in fact identical across countries. Every year, The Economist magazine publishes light-hearted version of PPP. It's hamburgers index that compares the price of McDonald's hamburger around the world. And this is like more advanced version of PPP, which looks large number of goods and services on the key problems. Is that the people in different countries consume different sets of goods and services, making it difficult for comparison of purchasing power between the countries. It's quite not just only difficult but challenging also. PPP currency is overvalued, undervalued. Yes. The two charts compare here. Now we have, two charts which enables us to compare and see the exchange rate related to the US dollar and the relative to Canadian dollar. This one, the red chart area is undervaluation of currency relative to US dollar, and the green is the area which shows overvaluation. Followed by we have another chart which is again the red indicating the undervaluation and green indicating the overvaluation. And the currency listed below here are European euros, euros. This red bar indicates undervaluation and the local currency. The currency appreciates against US dollar in the long run. The currencies listed below are the Canadian dollars. Again, the currency is overvalued by the percentage figure, and red bar indicating undervaluation of the local currency. Now let's look at implications of purchasing power parity. Now the implications are, firstly, differences in transportation costs, taxes, tariffs. The countries with many trade agreements will have lower prices because they have fewer tariffs. If you have lot of many agreements among the countries with the countries, then definitely you will have the fewer tariffs. Socialist countries will have higher costs because they have more taxes. And the second reason is that, like real estates, haircuts, these are the things which cannot be shipped. We just learned houses, local services, this cannot be shipped. Only ultra wealthy global travelers can compare the prices of home in New York to those in London. Only those, ultra wealthy global travelers, not the common man comes in this list. A third reason is that not everyone has the same access to international trade. Like, in rural China, can't compare the prices oxen sold throughout the world. But Amazon and other online retailers are providing more real purchasing power parity to even rural dwellers. This is a new revolutionary, attempt. Another fourth reason is that imports costs are subject to exchange rate fluctuations. They're subject to export rate fluctuations. When the US dollar weakens, then Americans pay more for imports, for importing any product. Whereas the most significant drivers of changing exchange rate value is exchange market, foreign exchange market. This creates wide swing in exchange rate value. Now, a small example is discussed here. 2014, many traders shorted the euro. The European Union's currency dropped. As a result, throughout the EU also fall. When traders again began shorting the US dollar in 17, the dollar too weakened. So with this, now let's move on to the next theory. That's theory of interest rate parity, that is IRP. This is a theory in which differential between interest rates of two countries remain equal to the differential calculated by using the forward exchange rates. Now, this, IRP plays a very significant role in the forex markets. Basically, this theory, supports that there will be no arbitrage in interest rates differentials between two different countries. And the differentials will be reflected in the discount or premium for the forward exchange rate on the foreign currencies. Now let's see, the cases are given here: home investments and international investments. Now let's take this case one, a simple and short to understand better this IRP. Let's consider investing. You can see, as shown in the figure below, we'll have two options as an investment. In the US, let the spot exchange rate be $1.2245. Practically, we get an exchange for our euro 1,000 at $1.2245, which is again equal to $1,224.50. We can invest this money at the rate of 3% for 1 year, followed by it will yield $1,261.79 at the end of the year. Now, the basic assumptions on IRP theory is mobility of capital and perfect substitutability of the assets. It is assumed that capital is mobile. Investors can readily exchange domestic assets for foreign assets. Also, it is assumed here that assets have perfect substitutability. That means that investments with similar risk and liquidity features. Now, given the capital mobility and perfect substitutability, definitely investors would be expected to hold those assets offering greater returns. And, be the whatever it could be, a domestic or a foreign asset. But, there's no difference which can exist between the returns on domestic assets and returns on foreign assets. Here, the earnings out of this investments probably may lead to an equivalent returns. But a single investor or a given site would expect to earn equivalent returns from either of these investment decisions. Next, we have covered interest rate parity, that is CIRP. What is covered interest rate parity? It's a theoretical condition in which a relationship between interest rate and the spot and forward currency values of two countries are in equilibrium. The covered interest rate parity situation means there is no opportunity for arbitrage using forward contracts, which often exist between countries with different interest rates. Now, here you can see an example is presented of Yahoo Inc. The US-based MNC has to pay European employee in euros in a month's time. Now, this can be done in many ways, and one of which is Yahoo can buy euro forward a month, that is 30 days, to lock in the exchange rate. Then they can invest in dollars for 30 days, after which, if they are converting the dollars to euro, usually we call it as covering. Now, Yahoo Inc. will have no exchange rate fluctuation risk because they've converted into dollars to euro. Firstly, they have invested in dollars and they are converting these dollars to euros. This process is called covering process, which enables to minimize even zero the exchange rate fluctuation risk. Then happily, they can adjust the salaries which they are due, which they are due to their employees, that is European employees. Another way is to convert the dollars to euro first at the spot exchange rate, then invest in euro money. First convert dollars into euro, then invest in euro money in a European bond or anything. For 1 month you can invest, and then then Yahoo can pay the obligation to you in euro after 1 month. Right? So either one or second case. Now see, under these models, both if Yahoo is sure that it will earn an interest in both the cases, it will convert fewer dollars to euro today. And the very reason is euro's growth via interest earned. This particular process, we also called it to be a covering, because it is converting the dollar to euro at the spot rate, that is current rate. This is eliminating the risk of exchange rate fluctuation, whatever could be the rate yesterday or tomorrow. But today, currently, whatever rate is being there in the spot market, that spot rate is being considered. This will totally eliminate the exchange rate fluctuations. And probably the equation can be represented as given below, where F stands for foreign exchange rate and T stands for time. Uncovered interest rate parity, that is UIP. Now, this theory proposes that the expected appreciation, or it could be sometimes depreciation also, particularly is zeroed, that means minimized to the extent zero. How? By lowering interest rate. This uncovered interest rate parity theory states that the difference in interest rates between two countries will equal the relative change in currency, foreign exchange rates, over the same period. It is one form of IRP, which is used alongside covered interest rate parity. For example, covered interest rate, suppose a Yahoo can implement to invest the money in dollars to change it for euro at a time payment after 1 month. Here, this method will be known as uncovered because the risk of exchange rate fluctuation is sure. And when there is no arbitrage condition is satisfied without the use of forward contract to hedge against the exposure to exchange rate, IRP is said to be uncovered. This uncovered interest rate parity enables one to understand and explain the determination of the spot exchange rate. And to calculate this spot exchange rate, the following equation is used, wherein E of T, ST plus K is expected future spot exchange rate at time. K is the number of period into the future from time T. S is the current spot exchange rate at a given time. I is the interest rate in one country, for example, United States. Again, I is the interest rate for another country, like suppose Eurozone. And hence this equation is formed, which can be used to calculate the uncovered interest rates. So, implications of IRP theory. This theory holds good. Which means that even if investors invest in domestic or foreign currency, the return on investment will be same. If the investor has invested in the domestic currency. In order to prevent foreign currency arbitrage, domestic interest rate is below foreign interest rate, and given this condition, the foreign currency when domestic rate exceed the foreign interest rates, excuse me, the foreign currency should trade at a forward premium. This is again to offset prevention of domestic currency arbitrage. Thus, the foreign investors can gain profit by investing in domestic market. Now, limitations of IRP. This IRP has been criticized on the assumption with which it comes, like infinite funds availability, which can be used for currency arbitrage, which is obviously not realistic. It is not true. It cannot, happen practically. But when futures or forward contracts are not available to hedge, then uncovered IRP does not tend to hold this in this real world. Okay, so these are the limitations. Okay, let's move on to understand the Fisher's effect. The Fisher effect is an economic theory which is created by economist Irving Fisher that describes the relationship between inflation in both real and nominal interest rates. Okay. The relationship between real nominal interest rates and inflation, let us try to understand. The Fisher's effect states that in response to a change in money supply, the interest rates will also change with the change in inflation rate in the long run. Suppose a small example, if monetary policy causes inflation to increase by say 5%, the nominal interest rate in the economy would eventually increase by 5%. Okay, this phenomena which appears in the long run but may not be present in the short run. It applies only to long run because it's a long duration. In other words, supposing interest rates don't immediately increase when inflation changes. The reasons could be like because of number of loans have fixed nominal rates. Interest rates were set based on the expected level of inflation. If suppose unexpected inflation has come, real interest rates can drop in the short run because nominal interest rates are fixed. But however, nominal interest rates will adjust to match up with the new expectations of inflation. Hence, this to understand better the real interest rates, a formula is given wherein we happen to subtract nominal interest rate minus inflation rate. Now, see in this given example, suppose a nominal interest rate in the economy is 8%. Inflation is 3%. What this means, for every dollar someone has in the bank today, they will have $1.08 next year. But however, because services or products got 3% more expensive, their $1.08 won't buy 8% more products next year. This means that only they can buy 5% more. And this is why the real interest rate is 5%. Let's see. In the above example, a real interest rate is equals to nominal interest rates minus inflation rate. The relationship we can clearly see. When the nominal rate of interest is same, the inflation rate is zero. If money in a bank account earns 8%, but prices increase by 8% over the course of year, the money has earned a real return of 0. Okay, so 8 minus 3% is 5%, whereas 8% minus 8% is 0%. If your inflation rate and nominal rate are both same, inflation rate and nominal rate both are same, then real rate, interest rate will be 0. This Fisher's effect shows in response to supply, supply. Therefore, it is said that the money supply should not have an effect on real interest rate. Okay. Then we have next theory, theory of international Fisher effect. This, Fisher's effect, IFE, combines two theories. One, two conditions, like, the purchasing power parity, which is all about the exchange rates, rise in the inflation rate in India in comparison to those other countries will be associated with any fall in the rupee value. The result is in the the rise in the interest rates in India in comparison to other countries' interest rates. Now, combine these two conditions, we have the results of IFE, wherein it states that the expected differences between the exchange rate of two countries is approximately equal to the nominal interest rates. Now, according to this theory, IFE, this implies that the interest differential between any two countries is an unbiased predictor of the future exchange in the spot. This condition is violated and investors require a risk premium to hold their foreign assets. In this case, IFE will not hold exactly the way. Now let's see the implications of IFE. Now here, there's a clear tendency for currencies with high interest rates to depreciate and those with low interest rates to appreciate, increase, decrease, and increase, respectively. Now, the ability of interest differentials to anticipate currency change is supported by several empirical studies that indicate long-run tendency for these differentials to offset exchange rate changes. Thus, at any given time, currencies bearing higher nominal interest rates can be reasonably expected to depreciate relative to currencies bearing lower interest rates. And one possible reason for this result relies on existence of time varying exchange and premium, risk premium. Okay, so now let's try to understand the comparison of three theories. That's PPP, purchase power parity, IFE, IRP theories. Purchasing power parity. This is related to spot exchange or inflation rate differences. The spot rate of one currency with respect to another will change in contrast to the inflation rate between any two countries. The effect of this is on the purchasing power of consumers. When purchasing power for consumers in their own country will be similar to their purchasing power when importing goods from the foreign country. Okay, then we have IFE. spot rate of one currency here with respect to another will change in accordance with the differential in interest rates between two currencies. Here in the PPP, it is about inflation rate. Here under IFV, it is the same spot rate, same currency between two countries, but the main ingredient is interest rates. And here it is inflation rate, differential in inflation rate. Here it is differences in interest rates. And when we look at IRP, what is IRP? Forward rate of one currency. See here in the above two, these are based on the spot. These are based on the spot. That's a PPP and IFE. Whereas interest parity is based on forward rate of one currency with respect to another. Now, since this being a forward rate premium, the component of discount is added. Hence, this determination will depend on differential in interest rates between two countries. As a result, the arbitrage interest will provide a return that is not higher than a domestic return. I hope it is clear to all of you. The PPP, purchasing power parity, which is dependent on spot rate, and it is the complete reaction depends wholly on the differential in inflation rates, whereas IFE, it is also spot rate of one currency in any two given countries. But yes, the component here which is making an impact and differences interest rates. Whereas under IRP, that's interest rate parity, it is with respect to a premium because it is based on forward rate, which is determined by differential in interest rates between two countries. Hence, an interest arbitrage will be provided. Okay. So the second unit is done, and the important questions summary is all there. The important questions revolve around the PPP, what is it, NIR, RIR, inflation, covered interest rate, uncovered interest rate, and also short answers on differentiating PPP versus IRP, PPP versus IFP. On the same lines, long answers, questions based on purchasing power parity and its rationale, international Fisher's effect and its rationale behind the theories, complete theory, including their implications, can be prepared and focused on. So with this, we end our session, today's session on Unit 2. Theories of foreign exchange. Thank you, everyone.